There's some hoes in this house. There's some in this house. In this house. There's some in this house. In this house. There's some hoes in this house. In this house. There's some in this house.
Inflation is a topic of conversation. We hear Joe Manchin talk about inflation being the reason why he doesn't want to get on board with more government spending. We hear a lot about inflation affecting homeowners and affecting the housing market, and that's what I want to focus on. I'm going to go over some basics, and then we're going to watch a podcast from a real estate investment advisor to kind of like break down what's going on in the minds of these people. What is inflation? What does it mean? How does it affect us as consumers? So inflation is a term that is used to describe the increased costs in goods and services, but how does inflation really happen? So inflation is literally something that the federal government is in charge of taking care of or responding, and it comes down to two entities that work separate and simultaneously to get a better understanding of how inflation occurs and how it's dealt with. So we have the Treasury Department, which is headed by Janet Yellen. She is the Secretary of the Treasury, and she oversees the money that is coming into and going out of the government. It is literally the Treasury responsible for, issuing bonds, bills, various forms of currency, and the Federal Reserve kind of regulates the money supply that is issued by the U.S. Treasury. They are working in tandem, but also very separately. The Federal Reserve is obviously our central bank. The Treasury works closely with Congress, not the president, to determine how much money will be spent. Also, the Federal Reserve policy decisions or monetary policies, they are based on the Treasury's yield curve. So what is the Treasury's yield curve? It is the first mover of all domestic interest rates and influential factors in setting global rates. So on our global market system, we have the Treasury that's issuing bonds, bills, and they are using the Treasury yield curve to determine the interest rates on short-term and long-term bonds that the Treasury Department does issue. Interest rates on all other domestic bond categories rise and fall with treasuries, which are the debt securities issued by the U.S. government. This is going to be a key component that will be discussed at length in our podcast video. So, to attract investors, any bond or debt security that contains greater risk than that of a similar Treasury bond must offer a higher yield. For example, a 30-year mortgage rate historically runs 1 to 2% above the yield on a 30-year Treasury bond. This is where the Federal Reserve is also acting as a regulator over U.S. Treasury securities by keeping a close eye on the Treasury curve and the yields of the Treasury curves. It's actually through the Federal Open Market Committee that they are keeping an eye and making specific decisions based on what the Treasury yield looks like, literally at the end of the day. I actually pulled the Treasury yield information from this month. This is the 1, 2, 3, and 6 month interest rates that are tied to the Treasury yield curve from this month. So on the x-axis, you have the total number of days and how these interest rates literally change every day. Every day, there is a different interest rate that's tied to these various bonds, depending on the longevity or the maturation of the bond itself. Here are the years, the year or the annual bonds. This is the 1, 2, 3, 5, 7, 10, and 20-year bonds. Much cleaner in how they are succinct. They look like synchronized swimmers. The other ones are kind of all over the place. It's very clear that this is a fickle system. The monetary policies that are applied usually to long-term Treasury bond related issues. It's a system that I don't think people are supposed to realize what the fuck is going on. Something else that I want to add real quick is that the treasury bonds that are issued can be bought by investors just like any other share that you can buy on Wall Street. That is one of the reasons why I believe that this is such a fickle system, because there is a lot of people who are entering into this incredibly dangerous market that is seemingly backed by the US Treasury, and that is supposed to offer some semblance of reliance on the ability for the US Treasury Department to make good on their outstanding debt that they are issuing to various bondholders. You might be surprised to learn how there is still a market to bet against US Treasury bonds. So the New York Fed is authorized to buy and sell Treasury securities to the extent to carry out the most recent Federal Open Market Committee directive. Operation results include all outright purchases and sales of Treasury securities conducted, including small value exercises. All right, so how does this all tie in with inflation? Simply put, inflation is the increase in costs in goods and services, and inflation is actually something that the Fed is not only responsible for kind of overseeing, they're also incentivizing inflation. The Fed is looking to measure inflation over time in a given year. They use the PCE price index, which is the personal consumption expenditures index for goods, services, food, clothing, things that you have to go out and buy as a consumer. They also use another metric that measures inflation, which is the CPI. The CPI is the Consumer Price Index, and it's measuring the change in out-of-pocket expenditures in all urban households. The Fed typically uses PCE. It is their main measure for inflation. And that's typically how they meet their statutory mandate to incentivize that 2% inflation rate year over year that they are targeting. The Bureau of Economic Analysis Personal Consumption Expenditures Chain Type Price Index for September shows that core inflation is above the Federal Reserve's 2% long-term target at 3.64%, while the Consumer Price Index measuring the change in out-of-pocket expenditures of all urban households is at 4.03%. So the CPI is now double the 2% inflation rates, which is pretty serious considering that the Fed doesn't even use the CPI as its main standard for measuring that year-over-year inflation rate that they're shooting for. We're going to watch a little bit of a podcast from a real estate advisor. This is going to be painful. I'm not going to lie. Let's do it.
Welcome to the Real Estate Strategies Podcast, a place for conversations that matter in order to obtain infinite wealth.
I know we're just getting started with this, but I have to say that a lot of real estate advisors who also have podcasts tend to employ this language, which is not true, but also a pillar of finance capitalism, where the underlying assumption here is that it is a cyclical boom and bust that will eventually give a very select number of individuals the potential to accumulate infinite wealth, while the vast majority of players end up holding the bag.
Hey everybody, it's Ken and Danielle.
Hello.
Hey, and we've got my friend Clay Akwinzi. Clay, what's going on?
Oh, not much, Ken. How you been?
So a lot of you guys have asked, like, where do Ross and I get our money, and how does that all work? Well, Clay's right in the center of a lot of it. So Clay, welcome to the show. Before we jump in, let's have a quick conversation about your background. And today we're going to kind of talk about inflation and interest rates.
It's a pleasure to be here. Thanks so much for having me. And yeah, I mean, I basically kind of stare at the U.S. Treasury yield the better part of every day for the last 15 years. And so it's definitely something.
Could you imagine that being your life, though?
Um,
What do you learn from looking at this Treasury yield curve every day? I don't know what this is supposed to tell us. I guess we're going to find out.
People always want to know, obviously where they go. I don't want to put a spoiler here, but I don't know where they're going, Ken.
I know. Well, first of all,
Imagine being like, I actually don't know why I stare at these Treasury yield curves all goddamn day.
I went through lots of training. As when I first got into the business, I spent 6 months in a credit training program. And they had like a manual like that was like 12 inches thick. And it was like all of the areas of concern. These are the like.
it's now 2 feet.
I like
instead of wood, right?
They're just like having such a good time. Like they're having such a good time, like laughing and talking about, the possibility that we're about to have another market collapse. I would imagine it's much better to be on the receiving end of a market crash if you have the assets and the portfolio to diversify, to hedge your bets, the likelihood that you will also get a government handout. I mean, the government has bailed out Wall Street so many times. Why wouldn't they do it again?
By the way, the reason why I wanted you to say that, thank you, is perfect, because it's going to happen again. That behavior, guys, it'll happen again. We are going to have a downturn. There's no question as it'll just be when, and nobody can predict that. And I was watching Jim Rickards the other day, who I love, and he said,
they know what's going to happen.
The bubbles are easy to spot. What's not easy to spot is the timing.
We're always watching the Treasury market because that's kind of the metric that people use to measure risk. So am I getting paid appropriately for the risk that I'm taking? And the way you measure that is by the risk-free alternative. So we spend a lot of time watching the Treasury market.
I believe that in this instance, the risk-free alternative means that it is a government entity that is issuing this bond. The reason why U.S. Treasury bonds are considered a debt-free alternative is because they are backed by the U.S. Central Bank, and the U.S. Treasury Department always pays off their debts that they have issued in the form of Treasury bills, bonds, etc.
What's made it more difficult, like really since the Great Recession, back when $700 billion was a lot of money.
Which wasn't very long ago.
That used to be a bazooka.
I know.
Now we're talking $3.5 trillion. I mean, it is.
So just so you know, that $700 billion, I believe that is a reference to Tarp. That was the 2008 buyback program issued by the United States Treasury. Basically, the banks had the ability to hold on to those toxic assets, which were the foreclosed homes, and then got the buyouts from the governments, which allowed them the opportunity to pay down the outstanding debt on those foreclosed homes, turn around and sell those homes, which then allowed institutional investment banks or institutional investors like Blackstone to purchase those homes for cheap. And that's where they started to diversify their portfolios of single-family homes that they converted into rental units. So from Tarp led to this new rental securitization market where institutional investors started to buy up those foreclosed homes specifically for the purposes of converting them into single-family rentals. That is now making it really difficult for individual consumers like you or me to even enter the buyer's market. Also, so when you said 700 billion used to be a lot of money, now it's 3.5 trillion, that is directly related to or referencing the current buyback program that we're seeing from the Federal Reserve.
We're kind of in this deficits don't matter realm of thinking right now. And so it's really hard to parse out, like, what is the actual what would be the yield on 10-year treasuries today, absent the Fed's kind of intervention? It's hard to say. And, could say the same thing about LIBOR, which was the old short rate. That was a rate that we got rid of because of all of the manipulation that the banks and those guys in England were doing, saying kind of, what's the rate today? I think it's going up.
Well, just out of curiosity too, what is the difference between a subsidiary or an insurer that's, part of Lloyd's of London making these decisions and, the U.S. Treasury Department determining interest rates? It kind of just seems like people who are in charge just make shit up. And how do we even know?
You're trying to kind of get a feel for what data sets are coming out and what impact those data sets are likely to have on the market's appetite for treasury bonds. And so, I think that's what we spent a lot of time doing. I don't know. It sounds pretty boring now that I talk about it.
I don't think that the reverberating effect that this has on the entire real estate market, that includes vulnerable renters that are still at risk for eviction, it's not boring. It's actually incredibly, incredibly nerve-wracking to see how nonchalant and cavalier these people are when talking about what could be incredibly disastrous market crash that will lead to a lot of people experiencing the worst possible outcome.
So there is a market of people betting against the U.S. Treasury, betting on a default by the U.S. government, which is, again, to your point, it's kind of disorienting. It's like what?
Yeah, because it's no different than the various markets that started to pop up where all of the risk that was associated with buying debt on mortgage-backed securities was spread so thin. By the time the subprime mortgage market started to crash, nobody was really caught holding the bag because the bags were completely disseminated down to nickels and dimes. The only thing that the government could do was to provide a $1 trillion bailout to the investment banks that had done the most damage.
For you guys that might not know, if I mess up and Ross and I mess up and we can't pay something, what they do is they take back that collateral and that actually pays for the debt that we have. So, but is there a shortage of collateral?
I think there's a shortage of yield, probably more than there is a shortage of collateral. I mean, I think we're kind of in this weird place where risk pricing is very, it's hard, a very hard thing to measure. It's like kind of how much more yield do I need to get than that treasury market?
So what this guy says is actually quite jarring when you think about it. He's not willing to say that there is a shortage of collateral because there's so much debt that you can collateralize. What he's alluding to is that there's not enough guaranteed yield on your investment to be able to use as leverage in a collateralized market. And this guy says that I spend all day, every day looking at the treasury yield curves. And if this is how he is responding to the question as to what is wrong with our current real estate market, and he is saying there's not enough of a return on your investment. Well, real estate is one of the best investments that you can make. Everybody needs a roof over their head. Real estate appreciates in value, typically. And if there are so many people who are expecting a return on their investment, that yield is the real potential threat right now, causing a potential market crash, we are literally on the same trajectory as we were in 2008.
There are a few balance sheet lenders. We do, life insurance company loans with balance sheet guys who hold the loan to maturity. Most of these loans, probably 75% of the loan market is now still being securitized. So that old CMBS things where, you package the loan and you chop it up and you measure different risk profiles and different people buy different tranches of risk. That is still fundamental to how capital markets for real estate work.
What he has just said is that the same mechanisms that ultimately led to the subprime mortgage collapse are still employed today. The Big Short, if you have seen it, talks about how those who had bet against these mortgage-backed securities, and that the loan holders, the individuals who had taken out the mortgage on these homes and was issued a subprime mortgage, they weren't able to pay down their debt. And eventually that became true. People bet on those mortgages not being paid off, and they made a lot of money in the process. And so what he is saying is that now we have a market where people are betting or acting as the same individuals in The Big Short. People are betting against the ability to pay back what they owe to the U.S. Treasury Department.
So you, at the end of the day, sometimes you don't even know who's holding your mortgage, right?
Yeah. Yeah, absolutely.
Yeah, and the one thing that they're relying on, though, is that you pay it. Because that's how they get paid.
It's just so funny. It's so fucking funny to these assholes. Like, it's a big joke. So in the beginning of the video, they talked about how to manage your risk profile. And what that means is hedging your bets. Here are some notes that I've taken. Okay. Investors are advised to leverage the risky assets of their portfolio during times of inflation as they become what are known as hedges. A hedge is a just in case, something that usually moves in opposition to the market or isn't subjected to wild fluctuations. In this case, because of the way that the real estate market operates, it is subject to wild fluctuations because it is a game of monopoly to Wall Street investment banks and institutional investors and private equity firms. But for the most part, it is a constant. Everyone needs housing. It is a necessity that's constantly in demand. And for that reason, hedging is considered part of a diversified portfolio during times of inflation, especially if it is always in need and always in demand during times of changes to the economy or changes to the market, either driven by or in relation to inflation. It is also used as a mechanism to capitalize on other losses. That's where hedging comes in, to diversify your portfolio. If you are expected to take a loss because of changes in value on other assets that you have in your portfolio, you may leverage the assets that you have in the real estate market to help balance out your own shortfalls, right? Inflation also benefits real estate investors who are earning income from their rental properties, specifically property sectors with short-term lease structures like multifamily properties or, at this point, single-family rentals. The reason why this works to the benefit of a landlord with an income-producing property during these times of inflation, there is a justification that you can raise rents, especially if your mortgage rate stays the same. This actually is the reason why during these times of inflation, the burden falls disproportionately onto renters. They are experiencing an increase in costs on goods and services, as well as potentially increase in rents. Inflation helps either landlords or homeowners if they have a fixed rate mortgage, and that's it. One would think that landlords would not even try to increase their rents because we are very much still in an economic recession. A lot of people are experiencing the beginning stages of eviction. They are waiting to be evicted because there's no longer a moratorium on evictions. And landlords are moving forward, proceeding with lawsuits and processing evictions because they can. And instead of taking the rental assistance that has been issued by the U.S. Treasury Department, they are opting to forego that assistance, instead move to evict and incur that costs that is tied to outstanding rents that they didn't collect from their now evicted tenants. So that's landlords' decisions to evict their own tenants, even though there is a mechanism in place to collect on some of the outstanding debt that they owe, but instead they are opting out of the rental assistance altogether and just evicting. They are taking this opportunity for new and renewed tenants to increase rents exponentially. This is the average monthly rents for 1 and 2 bedroom apartments from January to October. And according to Apartment Guide, 90% of all states have seen an increase in rents from either a 0, 1, 2, or 3 bedroom apartment. This is the percentage change in rent from 2020 to 2021. We can see a dramatic increase in the cost of rent starting in about July and then making it all the way up to a 20% increase in rent for a 1-bedroom apartment and a 19% increase in rent in 2-bedroom apartments. Basically, what this means is that landlords are capitalizing on the opportunity to raise rents exponentially for their existing tenants that maybe were fortunate enough to not lose their job, maintain their monthly rental payments, and now they are paying the ultimate price. I want to pay tribute to a pretty big win in Berlin, Germany, where voters actually voted in a 56.4% referendum vote to expropriate large companies that held 3,000 or more units in or around Berlin, and basically called for a re-socialization of privately owned rental units that were causing a significant cost burden onto Berlin renters, who make up about 80% of the entire city. DW and Company began as a grassroots movement in 2018. It was during COVID that they had the opportunity to massively organize and massively reach a broader audience of people and brought in the slew of renters who ended up supporting this ballot initiative that allowed them to easily get this on the vote. And by referendum, they utilized their rights to organize and vote by direct democracy and asked that the Berlin government intervene and buy out from under these huge multinational companies these units to be socialized and given back to the people. Here in this country, you would never be able to reach this kind of majority opinion because of the fear-mongering and the Red Scare tactics that are associated with our goods and services that could otherwise be much more utilitarian-based, much more equitable and accessible if the government were held to a high standard and provided more goods and services and necessities that didn't require us to go into a private market and pay an exorbitant amount of money to have something as basic as a roof over our heads. But it doesn't mean that we don't try. Because here's the thing. It's not like there is a shortage of money that is available. And let me show you. Anytime a motherfucker says, well, how are we going to pay for it? Let's remember this. During COVID-19, the Federal Reserve has purchased so many treasury bonds and mortgage-backed securities, over $5.5 trillion. To be exact, it's not like the government can't pay for it. The government right now is paying a lot of money to try to stabilize our incredibly corrupt markets that are ran by crooks on Wall Street. It's not like the government could not intervene and buy as many properties as necessary through eminent domain, purchase them at fair or below market rate, and convert them into public housing units. They could, and we should, do what voters did and organizers did in Berlin and fight for the same outcomes. We can hold our government to a higher standard. We can demand that we have a balanced and equitable system that allows us to live a lot more comfortably. If the government would take some of that $1 trillion bailout that they're giving to crooked banks on Wall Street and give it back to our communities to give us safe, habitable, affordable housing. It is a right, and we deserve that.
There's some holes in this fault. There's some in this fault. In this fault. There's some in this fault. In this fault. There's some holes in this fault. In this fault. There's some in this fault. In this.
Back from the top. I'm a killer when I get in the pussy.